Hello, everyone. This is Andy Michael with Seven Springs Wealth Group. Hope your spring is off to a great start. Today, I wanted to share a quarterly market update. Would also like to address some of the volatility that we've seen in markets over the past several weeks, and would also like to show you how some of the themes that we talked about coming into the year have evolved over the last 3 months since our last update. So with that, let's jump in. First, we brought into the year this idea of rates and profits being the real theme that would drive markets. And so 3 months in, we just want to take a temperature check and see how some of those big themes are playing out so far 3 months into the year. First off, let's look at profit growth. We started the year with an estimate of 14% profit growth. That has actually increased over the last 3 months, despite all of the recent market volatility. And so to us, profit growth is very much on track for this year. If we skip down to midterm market volatility, we talked about how the average drawdown in the market is 18% in year two of a 4-year presidential cycle, that midterm year. So far, we've had a peak to trough in the S&P 500 decline of 9%. And so just this idea of having more volatility in the second year of an election cycle, certainly that we feel that's on track. We've certainly experienced that volatility through the first quarter and early start in the second quarter. What's really been off track for the themes that we discussed going into the year have been interest rates. You can see here across the board that we've had the 2-year yield, the 10-year yield, both increase in rate in yield rather than decrease. And the market's estimate for Federal Reserve cuts, interest rate cuts, has actually declined from having 1 to 2 cuts projected for the year to anticipating no cuts for the year. I would just add a caveat. These things can change very, very quickly. Today, we're recording on April the 8th. Rates are quickly and fastly evolving and moving in real time as events evolve across markets and geopolitics. So just put a caveat in there that adjustment's been made, and we'll see what happens as we move forward through the year. But those are really where the big themes stand so far. If we look at the performance for the markets to start the first quarter of the year, the big thing I would note is that the U.S. large cap stock market, the S&P 500, it's down about 4% for the year. Really, everything else, international stocks, small cap stocks, bonds, cash, real estate, is by and large not doing anything. And what that really was comprised of was 2 good months in January and February, and then 1 pullback month in March got us right about where we started the rest of the year. So despite the fact it's felt very volatile to get to this point, it's actually very, very small moves overall from quarter to quarter. The next thing I want to do is put the current Iran war into perspective compared to other market sell-off events. As of today, there was a ceasefire for 2 weeks. We will continue to see how that evolves in real time. What I do know is that these events will continue to evolve day by day. And so really, this is our opportunity to just zoom out a little bit and see how this stacks so far compared to other market drawdown events and how frequently we have market drawdown events. And so a couple of quick points here. We are right about at a 10% or so drawdown since the peak to trough decline in the market. It's a little bit higher now, but the biggest move we've had thus far in this current Iran war is 9%. So I'm calling that about a 10% move here. We've had about 56 of those over the last nearly 100 years. To get to a 20% move, only 22 of those 56 10% moves become a 20% drawdown. Only 19 of those 22 become a 25% drawdown. Only 13 of those 19 become a 30% drawdown. And we've only had 3 50% drawdowns or more in the S&P 500 over the last 100 years. So it really is a very significant once-in-a-generation type event to have one of those drawdowns. Of course, over the past 100 years, we had 2 of those with the dot-com bubble and with the Great Financial Crisis. We had 2 in a 10-year period. So I just wanted to put all that in perspective for where we stand today. On the left-hand side, I just show a few comparisons of what it takes to get those types of drawdowns. We had the Silicon Valley Bank collapse in 2023. That's about on par with where we are right now. I'd call that a big scare, but ultimately did not end up moving markets significantly beyond that. The global tariff trade war last year resulted in about a 20% drawdown. So think, it takes a global tariff type trade war against, allies and foes alike in order to generate that 20% type drawdown level. It takes a 9% inflation spike and the largest interest rate hikes we've seen in the last 40 years to get a 25% drawdown. That's what we had in 2022. And it takes a global economic shutdown due to a pandemic, like we saw with COVID-19 back in 2020, to get that over 30% drawdown. And it does take something like a great financial crisis to have an over 50% drawdown. So I want to show all those to show the scale of where we are today compared to the type of event it takes to move the market down these respective levels. I think at this juncture, probably where we are right now does make sense. This was certainly worthy of a correction based on everything that's happened with oil, and everything else going on in markets right now. It would probably take something more significant to get that next level down. Certainly could happen. Not to say that it won't, but based on where we are right now, I think this correction territory certainly makes sense given the current scale of the event. Moving on, this is the same slide that we looked at 3 months ago, but now I've updated it to show whether these conditions are improving or worsening or have stayed about the same. Let's just focus on the ones that have really changed over the last 3 months. As we mentioned, revenues and profits are actually improving. They're not compared to expectations going into the year. So that's great. As we mentioned, we don't have lower interest rates. We actually have higher interest rates, and financial conditions have tightened a little bit rather than loosened over the past 3 months. So both of those have had hit some short-term turbulence there. But we are seeing market breadth continue to participate. It's not just seven large companies driving the market anymore. We even saw that in that first quarter performance that they've actually all outperformed just the U.S. large cap stocks alone. Starting valuation. So that was a concern that has actually improved. So if we've had the market come down in price, yet profit expectations go up, that means we have lower valuations than we did at the start of the year. I think that's a very healthy sign. Frankly, you're just getting a better price for what you're buying, and you're getting more expected profits for what you're buying today to start. So that's actually a concern that's been somewhat addressed through this volatility. Clearly, geopolitical risks were a concern as we came into the year. That is fully materialized. Even if we get some type of resolution or temporary resolution with the war in Iran that even holds, it's not to say there's not another geopolitical risk that's right on the heels of this war in Iran. We've already seen it with Venezuela this year, with Greenland. You've even heard talks about Cuba. And certainly that doesn't even include geopolitical risks outside of the U.S.'s direct involvement in the situation. So certainly still something that we're keeping a close eye on. Iran absolutely fits in that concern, but still something that we want to look out for even beyond Iran this year. So really to bring it all home, where does that leave us in our investment strategy? And to me, nothing has changed here, which is gives me conviction in the investment strategies that we set. They can hold longer than a 3 month time horizon, which is the entire point of why we create these investment strategies and things to take away. As we've shown, it's still a great time to diversify beyond large cap. That doesn't mean don't own large cap. We still want to hold these U.S. large companies. These multinational companies are excellent businesses to hold for the long term. It just means we want to own things beyond just those. And we've seen that broadening participation already start the first 3 months of the year. Fixed income, this has actually gotten better as a result of those interest rates going a little higher. You are now getting paid even more. to own longer maturing bonds than we did even to start the year. So if you do know that you have that longer term need, this is a wonderful time to be able to purchase some of those longer term bonds and some things that we've been looking at and taking action on in portfolios today. And then finally, I continue to just emphasize this: preparation beats prediction all day, every day. It's impossible to predict what's going to happen at any certain moment in time. Even if you knew what was going to happen, it's very challenging to know how the market's going to respond to whatever the event is. So this is not the time to be trying to make broad, strong predictions. It's a time to have a really good game plan, both for your financial plan, for your portfolio, how you're going to respond if the market moves significantly higher, how you're going to respond if it moves significantly lower, or if we just find ourselves in a choppy sideways move this year, like by and large we've largely seen to start the year so far. That's it for us today. Wanted to just get this quick update out to everyone. If you do have any questions, please don't hesitate to reach out. Thanks so much, and we'll see you next time.